Aberdeen Group shares fell as much as 7% in early trading on Wednesday, even as the asset manager posted a 21% rise in adjusted operating profit to £151 million, beating the consensus forecast of £145 million. Earnings per share of 8.2 pence also cleared the 7.4 pence estimate. On the numbers that usually move a stock, Aberdeen delivered. The market sold it anyway. The reason sits one line below the headline. Aberdeen recorded £3 billion of net outflows across the group in the first half, more than 3 times the £900 million reported a year earlier. Analysts had not modeled an outflow at all. The consensus was for roughly £800 million of net inflows. Excluding lower margin liquidity products, outflows still ran to £1 billion, with the investments division alone losing £5.6 billion, about $4 billion of that from equity withdrawals. A £1 billion credit mandate expected in the second quarter was pushed back to early July. Chief Executive Jason Windsor was direct about the split. Interactive Investor, the retail direct-to-consumer platform, pulled in a record £6.8 billion and grew its customer base 14% to 525,000. But bigger institutional clients in Aberdeen's other units were leaving, consolidating with fewer managers. 2 businesses inside one group are moving in opposite directions, and the 7% drop is the market pricing the weaker one as the more informative signal about where Aberdeen is actually heading. Interactive Investor's own profit rose 18% to £84 million, with assets under administration and management climbing 15% to £108 billion. Peel Hunt called it the star of the show, describing group profit as excellent and well ahead of its own forecast. If Interactive Investor were reported alone, this would read as an unambiguous growth story. The drag came from elsewhere. Aberdeen's advisor business recorded £1.3 billion of net outflows in the half, worse than the £900 million a year earlier, even as gross inflows rose 9%. Redemptions increased by £700 million to £4.9 billion, overwhelming the improvement on the inflow side. Adjusted operating profit in the advisor division itself slipped 2% to £41 million. Windsor called the group impatient to go further and said there was more work to do on flows, an admission that the turnaround he has been running is not yet complete. This reframes what kind of story Aberdeen is telling investors. Under Windsor, the shares had already climbed 21% this year into Wednesday's results, on the back of a cost-cutting drive that pushed the company back into the FTSE 100. That phase, proving costs could come down and profit could recover, has largely worked, and today's numbers confirm it. But a turnaround built on cost discipline eventually has to prove it can also hold clients, and this result is the first evidence that the harder half of that job, stopping institutional money from walking out the door, is still unresolved.
Aberdeen kept its full-year guidance unchanged, targeting at least £300 million of adjusted operating profit and around £300 million of net capital generation for 2026, and held the interim dividend flat at 7.3 pence. Management is treating the outflow surge as a within-plan wobble, not a guidance-changing event. The company is betting the market overreacted to a one-off institutional redemption pattern rather than a structural shift in how clients view Aberdeen. Peel Hunt's framing captures the disagreement embedded in the 7% drop. The broker said the market had been grudging at best in believing in a better Aberdeen emerging, but still judged the underlying recovery to be taking shape and kept its rating. That is one house reading the sell-off as sentiment lagging fundamentals. The price action on the day argues the opposite, that investors are weighting the outflow trend more heavily than the profit beat until it reverses. The next concrete checkpoint is whether the delayed £1 billion credit mandate lands in the third quarter as expected, and whether advisor outflows narrow back toward last year's run rate. Until one of those shows up in a reported number, Wednesday's move stands as the market's verdict. A profit beat driven by one growing division is not enough to offset unresolved doubts about the other two. Holders are being asked to judge Aberdeen on client retention now, not on cost control, and that evidence has not yet arrived.